EBITDA is one of the most quoted numbers on Wall Street, and also one of the most misunderstood. You hear it on earnings calls, in headlines, and in deal announcements. But what does EBITDA actually mean, and why do investors, bankers, and analysts rely on it so heavily? EBITDA stands for earnings before interest, taxes, depreciation, and amortization. In simple terms, it's meant to show how profitable a business is from its core operations before accounting decisions, financing structure, and tax environments get in the way. Wall Street likes EBITDA because it strips a company down to what it earns from running the business itself. The logic is straightforward. Two companies might sell the same product and generate the same revenue, but one could look far less profitable simply because it has more debt, higher taxes, or older equipment. EBITDA removes those differences, allowing analysts to compare companies more easily across industries and countries. This is especially important in capital-intensive businesses like telecom, airlines, manufacturing, and private equity-owned firms. These companies often have massive depreciation expenses and heavy debt loads. If you only look at net income, they might look unprofitable, even if the business is generating real operating cash. EBITDA helps answer the question, does this business actually work before financing and accounting choices? Wall Street also loves EBITDA because it's widely used in valuations and deal-making. In mergers and acquisitions, companies are often priced as a multiple of EBITDA, 5 times EBITDA, 10 times EBITDA, sometimes more. Private equity firms rely on it to evaluate how much cash a business could generate to service debt after an acquisition. In that context, EBITDA becomes a proxy for operating cash flow. But here's where the problem starts. EBITDA is not cash. It ignores real expenses that companies cannot avoid. Interest matters because debt must be repaid. Taxes matter because governments always get paid. And depreciation may be non-cash today, but assets eventually need to be replaced with real money. This is why critics often joke that EBITDA stands for earnings before everything bad. Companies can look extremely healthy on an EBITDA basis while struggling in reality. A business with high EBITDA but weak cash flow may not be as strong as management suggests. Another issue is that EBITDA is easily adjusted. Companies frequently present adjusted EBITDA, which excludes restructuring costs, stock-based compensation, legal settlements, and other expenses labeled as one-time. The problem is that many of these costs happen over and over again. When everything is excluded, EBITDA becomes more of a marketing number than a financial one. Real-world examples are everywhere. Airlines, streaming companies, and tech firms have all reported strong EBITDA while burning cash quarter after quarter. In extreme cases, businesses have gone bankrupt despite reporting positive EBITDA, because they couldn't meet debt obligations or fund capital expenditures. So why does Wall Street still love it? Because EBITDA is useful, when used correctly. It's a starting point, not a conclusion. It helps investors understand operating performance, but it should always be paired with free cash flow, capital expenditures, debt levels, and net income to get the full picture. The key takeaway is this: EBITDA tells you how a business performs before financial engineering. Cash flow tells you whether it survives. Smart investors use both. If this explanation helped you understand what EBITDA really means, and why it's both powerful and dangerous, follow Real Business today for clear breakdowns of business, finance, and how money actually works behind the numbers.